Hi, folks. Welcome to the Weekend Investing Stock Market Weekly Review for the week ended 4th of July. So, a dull week on the Indian markets. Markets were coming off, but there were no major moves as such. I mean, it was like market is resting, waiting for some new cues, uh, perhaps from quarterly results that will start to pour in another 7 to 10 days. Um, Also, this week we were hit with this Jane Street order from SEBI. This will have some ramifications going forward as the first sort of immediate reaction is that all capital market stocks are getting hit because volumes of such large institutional players are meaningful in the market, and hence certain stocks may get hit on based on that. The second sort of discussion that is going on is the second order effects of such uh, regulatory orders, whether this will cause several other algo players who provide a lot of liquidity to the markets to withdraw from the Indian market. That could be a second order effect. Another third order effect could be that the regulator may bring in more tighter regulations around derivatives markets. So this can snowball into something more meaningful, uh, kind of a situation for the markets. But that's a developing story for the next month or so. We'll find out how this pans out. So that's where we are in the markets. The conflict front is reasonably quiet, and the main sort of story that is brewing under the covers is the tariff story, where it is still not clear the India-US tariff agreement and what kind of volatility that may cause in the coming week. From our research desk this week, we had all these fantastic stories to share with you. These are coming to you via our Weekend Investing app, the Weekend Investing blog on the website, and also delivered through YouTube and the newsletter. So you have many ways of reaching out to these stories and more. Please do go through all this content that gets created. It is a good way to learn more things about the markets. Disclaimer, as always, please read it fully and understand it, and only then go forward in this video. Do subscribe to the channel as well if you haven't so far. So this week we had a dull week, 0.69% down this week. If you see on the weekly chart, it's a minor blip given the fact that we have been running up since April, and we haven't really uh, come off it, the trend at all. In fact, we've just consolidated and went up. So this breakout that happened previous week was significant. We have not nullified it at all, and it is likely that we will retest this top in the coming weeks and months. 25,400 is a reasonable nifty level, to the extent that we were looking at 21,000 not too far back. So from that point of view, market is taking some time to digest this level again as it goes forward. S&P 500 meanwhile is going bonkers, 1.72% up this week, closed at a new all-time high, 6,279. This in an economy which is being touted to be as near a recession, where the debt is going out of control, where the interest rates are likely to go up if inflation goes out of control. The president wants the interest rates to come down, but the treasury chief wants to hold the interest rate. So in all that confusion and the conflicts, wars, etc., this market is making new highs. What does it tell us? It tells us that the confidence on the US market by the global players is still very high. So there is people don't see any concern about these things as yet, and a new high signifies that the US market still remains a safer haven for investors other versus other markets. That is the sort of uh, extract that you would get if whenever you will see something hitting a new high. It does mean that demand is outstripping supply in that market. Gold is also making a comeback, 1.9%, 95% plus this week. We've closed at 9,700 rupees to a gram. I think gold is also consolidating, and as soon as there is some disturbance again, which has not gone away. See, whatever conflicts have stopped are still simmering, and there is some chance that they will reappear soon again on the front headlines. So gold is also simmering there, 1.95%, and the next trigger may cause it to go to a new high. Dollar index, which was falling, was reasonably stable this week, minus 0.15% only. But the structure of the dollar index is very weak. It likely should go much, much lower as per most experts. The benchmark indices this week, small caps up 0.6% along with mid caps, Nifty down 0.69%, virtually nowhere. So, absolutely no point really talking too much about where this week led us to. And even in the sectoral moves, you had real estate come off 2%, private banks were down 1.5%, financial services down 1.8%, defense up 1.7% as government announced 1 lakh crores worth of new orders. Capital market, as I already mentioned, down 1.3%. Pharma and PSU banks up nearly 2 to 2.1%. So small moves, but no major moves as such in the sectoral overview. Defense, capital market, oil and gas, infrastructure, and IT remain the top five sort of average momentum score sectors. You can see that capital market has got hit in the last week. So has services sector here. So has perhaps even uh, banking and private banking to some extent. Uh, what is suddenly coming back up is pharma, PSU banks, defense, and oil and gas versus their previous positions. But overall, defense and capital market, you can say, have been reasonably steady at the top. And you can see that real estate, FMCG, energy, these stocks have continuously remained in the bottom score and not really going anywhere. So the market is very divided. And then, of course, there is a middle path where autos, PSU banks, metals are bobbing up and down right here. The advanced decline statistics for the indices is pretty much even. So roughly half the stocks advancing, half the stock declines, slightly more towards advances. But that really is not very meaningful for this week going forward. If we see the number of the percentage of stocks outperforming benchmarks, we have mid caps which have really done poorly this week. Only 41% of mid cap stocks actually outperformed the mid cap 150. The rest were nearly 55% or so in this range. And if we see even 3 months period, uh, less than 40% for most of the indices. So it means that most stocks are not performing as per the benchmark index. It's only fewer stocks that are causing that skew in the performance of those benchmark indices, and hence even more uh, uh, is the requirement that we be able to identify the winners of each index and ride them, because most of the stocks of the index are not performing even as much as the average indexes. Uh, in terms of the drop from 52-week high stat, it remains pretty much quite deep red. So 10 to 40% drop is huge in Nifty Next 50 also. So we have almost 70% plus stocks that are still in the 10 to 40% drop from the top in Nifty Next 50, in mid cap, and in small cap, and in micro cap it is even more. Only in Nifty 50 you can say that 50% stocks are less than 10% down from their top. So, very less damaged to that extent is the Nifty 50 stocks. And that is primarily perhaps because the FI selling also has reduced quite dramatically going forward. We'll see those numbers. But the large, if I mean, and that's not constant in the large cap space. Nifty Next 50 is showing a very different picture from Nifty going forward. Let's look at the trends, whether they're improving or declining. When we look at, let's say, 50-day moving average, it is slightly, you can say it is staying flat near 80% stocks. So 80% of CNX 500 stocks are above 50-day moving average, which is a decent number actually. It's not bad at all. And on the 200-day front, we are still at very low numbers. 56% stocks only are above the 200-day. I mean, this ideally, if it increases, will give more confidence in the market. Within the sectoral space, if we see the trends, if we check the 50-day moving average, we find all auto stocks above 50-day moving average. 90% of PSU banks, IT, private banks, infrastructure stocks also above 50-day moving average. So these have seen stocks that have started to rise. When we compare it to 200-day moving average, the same sectors may be still behind. So autos are only 53% for instance. IT is only 40%. FMCG is only 33%. So only private banks have been leading in terms of a healthy longer term trend above 200 DMA. Financial services, metals are also there. But you can see that energy, IT, public sector enterprise, FMCG are very faring very poorly when compared to longer term trends. So you could look at those trends and also position yourself accordingly. In the FII stats, we had FII selling on all 5 days of the week, but the selling was still minor, within 1,000, 2,000 crores each on every day. And DIIs bought, 4 days out of 5, and on the last day, even DIIs were sellers on this front. The volume of buying and selling had reduced this week quite dramatically. In the last 30 days, we now see that FII inflows are 4,300 crores. So there is no net outflow, at least from FIIs. And domestic institutions and DII cash buying continues to be very robust at 71,000 crores for the last 1 month. So this is where we are in the market. Thank you so much for watching the weekly review. Please do review it and give us some feedback how you like this content, what more you would like to see in this content, what part of it you did not like. We are always open for more feedback from you. And of course, do please subscribe to the channel. Thank you and see you next week. Thanks. Bye.